Hi gang, it's been a while since we've done a video, so I just wanted to go over something very important that I've discussed in the Substacks and I've discussed it on Twitter X, but I haven't made a video about this. This is going to be a short one, and I want to explain this to you simply because there's just a heck of a lot of people that don't understand what's going on right now. Okay? So, the people who follow my work very closely know all about this, but the rest of you really don't. And I've been tracking the markets since June 20th when Nvidia started dropping. It recovered, but it took 6 months for the biggest window I've ever seen to validate, and that's what happened on December 16th. Now, for those of you who have seen my Gann calendar video, you know all about that. You could watch that video. I'm not going to go over it here, but the bottom line is the following. The markets peaked on December 16th, which was the 265 DG vibrational day of the year. It was 166 days off the 2024 April low, and it was 266 months off the bottom of the 2002 end of the internet bear market. So basically what happened is that this is a 23-year cycle high, and practically nobody other than my posse knows about this. So what ended up happening, it peaked and it consolidated all the way into February. February 18th and 19th and 20th. February 20th was the 331 DG vibrational day of the year. It was also 66 degrees off the 265 DG day of the year, and that's where it started dropping. So you can see there's a relationship there. Not only that, but there was a mild rally based on a replication flip, which I've discussed elsewhere and will discuss again. You see, we have all the 65s and 66s at the high. The range to the low was 2966.34 points. Folks, that is not a coincidence. Okay? And you had a rally which terminated where? 66 days off the top. Imagine that. You know what? I haven't found a single person that was able to replicate that. Or should I say, come up with that at all. Nobody knows. Okay. So the thing is, we had the low here in March. We had the bigger low that's holding, and that was on April 7th. Okay. It wasn't on this chart, we didn't have the greatest reading at the low, but what we did have is the fact that the last leg, this last leg is 65% of the entire move. And if we've seen some of my other videos, you know that the first leg influences the whole, or the last leg influences the whole. And in this case, we had a 65% last leg, which is lining up at 65%, which jives with the rest of the pattern. Okay? So now, what ends up happening is, at the current moment, we have a reading of a 60% retracement of the whole pattern, and the inverse, which means the bigger leg in relation to the smaller leg, is 1.66. Now here we don't make predictions. It has not validated yet. But if Monday were to turn out and be a good distribution day, you'll know why. What I'm really looking at is the 66 DG vibrational day, which is coming up at the end of this month. All I know right now is with the 166 coming and the FOMC meeting this week, conditions are ripe for a change of direction, although it doesn't have to happen. But if it does happen, you'll know why. And when a good vibration like this fails to validate, it usually has a really decent move going in the opposite direction. And so at this point, here we have a chart that is testing its 200-day moving average. And if you look at some of the other charts, they're also testing their 200-day moving average. So it should be very interesting with the FOMC. We're coming up to the end of May. I mean, the months go fast. The end of May is the traditional and the seasonality factor of the markets. The end of May is sell in May and go away. Okay, so the most important thing that I wanted to talk about here is at first, most people didn't even understand that it was a bear that of these readings, so they didn't know it was a bear market. And most people have no clue. I mean, just look around. Look at business media. Look at Twitter. Look at CNBC. Look at some of the others. I haven't seen anyone really come across with the exact right answer to this thing. I think what we have here comes the closest. And now I have to explain to you why this replication flip with the 66s at the high and the 2966 low failed. It was because at this point, there was still no fear. The VIX barely hit 30 over here. Now, we're not in a bull market anymore. In a bear market, not only do we need the calculations to fire off, but we need the requisite amount of fear. And we had that fear down here as the VIX hit 60. It's, what is it, the third or fourth highest reading on record? So it changed. You get a reading, you get the fear level, which is appropriate, and that's what you have to look for. Now, on this rally leg, people are coming to the conclusion that the bear market's over. And maybe it is. I don't have a crystal ball. But from everything I've seen and everything I've been trained to see and everything we're watching here, this looks more to me like a bear market rally than a new bull. Because at the end of the day, I don't really see these people climbing a wall of worry. They're climbing because they just think AI is going to go higher and crypto's going to go higher and this is going to go good and that's going to go good. I don't see a wall of worry, and I just see people thinking that it's the light at the end of the tunnel. And what you should know is that there was over 100-day rally after the crash of 29, which people thought was the light at the end of the tunnel. They even came up with a song that we still listen to today, which is Happy Days Are Here Again. So the Happy Days Are Here Again rally came about in that early 1930 boost when people thought that the light at the end of the tunnel was better times, but they never thought to realize that the light at the end of the tunnel was an oncoming train. So we shall see. It'll be an interesting week, and I should be doing some more videos.